welcome to Global Business Insights, where we cover more details on the main headlines from the business perspective. US inflation was up to 2.7% in the year to March, according to the metric the Federal Reserve uses to set its target for price pressures. Chevron's first quarter earnings beat analysts' expectations, but were lower than a year ago due to lower international natural gas prices and reduced refinery margins. Chevron announced reported net income of $5.5 billion in the first quarter, down 16% from the same period last year. Earnings of $2.93 per share were above analysts' expectations of $2.90. Meanwhile, ExxonMobil missed analysts' estimates with a 28% year-on-year drop in Q1 profits as weaker refining margins and lower natural gas prices also offset gains in production volumes. U.S. Secretary of State Antony Blinken has said the U.S. and China plan to hold their first high-level talks on artificial intelligence within the coming weeks. We will replay the earlier clip on major shareholders voicing strong opposition to BHP's $39 billion proposal to take over AngloAmerican, calling it an opportunistic rip-off and fueling doubts over a deal that would combine two global mining giants. And the South African government Minister of Resources has his own views on the deal. Alphabet scaled the $2 trillion market value mark for the first time since November 2021 as investors applauded its announcement of a first ever dividend and a $70 billion stock buyback. Its value fell back after hitting the record high moments after the market opened. We'll also replay our deep dive on what we are learning from the big tech earnings season so far. Yesterday, we saw Deutsche Bank report profits up by 10% year-on-year since the first quarter. It was the highest level since 2013, helped by strong revenues from its investment banking and trading divisions. Its shares have seen a strong 60% lift in the last year, but commercial property losses are also piling up. We just got the data in today, the US preferred deflator, that's the personal consumption expenditure index, confirming price growth looks stickier than expected and won't be as easy to bring down, just as the Fed had been flagging, justifying the posture of the Apex Bank not to be in a hurry to pivot to easing. March personal consumption expenditures price index showed a headline growth of 2.7% year-on-year, higher than 2.6% expected, and also higher than prior month year-on-year growth of 2.5%. Headline inflation month-on-month was 0.3% as expected. The core inflation was 2.8% year-on-year and 0.3% month-on-month, compared to 2.6% year-on-year and 0.3% month-on-month, which again was as expected. Markets had expected an upside surprise on the inflation measure, and those slightly stickier than expected, not materially so. Futures inched up and treasury yields went down as they saw this as a soft inflation measure, not enough to change FOMC thinking in any material way. The next week's meeting will not feature any economic projections or dot plots. We have to wait till June to see how this and April and May data play into the decision, and that could affect the chances of when we're going to see the rate cut, as we will see in the dot plot. It's looking like inflation in Europe may be falling faster than in the US, and we could get Europe and the UK leading in cutting rates. When they meet next week, the rate committee is likely to acknowledge early signs of stickiness, only reinforcing the case for patience for the trend towards the 2% target to be clearer. Some analysts now say we may never see 2% for a very long time, and this higher inflation print may be more the new normal. Microsoft announced earnings per share of $2.94 versus $2.82 expected on 17% year-on-year growth in its revenue, hitting $61.8 billion, beating 60.8 expected. Microsoft can already see artificial intelligence pushing its cloud revenues. Alphabet shares jumped 12% after hours when it announced its first ever dividend on top of beating on earnings and revenue. YouTube advertising revenue at $8.1 billion beats $7.7 billion expected, and Google Cloud revenue at $9.6 billion also beat market consensus. Q1 numbers show also that the core advertising business is now reaccelerating after a difficult 2022 and 2023. Yesterday, we saw markets digesting Meta's results after Tesla's with different reactions. Though Tesla missed on forecasts, it was able to see a double-digit rally driven by narrative and guidance, which sold well to investors. Efficiency moves, measured AI spend, and cheap EVs coming sooner after shares sank 45% year to date sounded like a reasonable response. Meta announced impressive beats above Wall Street, but said that expected Q2 revenue would come in a range with a midpoint of at $37.75 billion below expectations for $38.3 billion. And additionally, it asked for patience to spend significantly more on AI infrastructure, which wasn't convincing, with shares looking already expensive, up 50% year to date. Meta's foray with Metaverse already makes it appear to be spreading itself too thin. But the other good news from Meta didn't seem to matter. Earnings per share of 4.71, beating the consensus on revenue of 36.46 billion, also comfortably surpassing expectations, did not impress investors. What are markets and investors looking for, especially when we consider technology stocks? First is monetization of artificial intelligence. Microsoft has infused AI into its mainline lines of business successfully, such as cloud computing contracts and subscriptions for its email and other online services, and can show a clearer monetization path. And AI-related growth in its cloud services is already apparent. Nvidia is also benefiting from all the capital AI expenditures from the downstream players. Efficiency is another issue. Inflation now stickier means a hold on costs matter, and shaving fat rings well with investors. Alphabet, Tesla, and many others have been cutting costs in anticipation of slower growth and tight margins. Resilience to recession definitely is key. How resistant is the business model to a stagflation? Tesla's focus on cheap EVs sooner was a hit with markets, given where consumers are with their wallets. Future guidance obviously is important. Growth tech stocks are priced for the future and not the past. And though fundamentals still count, price multiples count, share buybacks and dividends sell well in returning cash to shareholders who are running out of patience, it's very important that the guidance also is upbeat. Alphabet first ever dividend definitely went down with markets. The trade-off associated with capital spending versus profits also needs to be clearer, and markets are making their own judgment calls on whether cash chests are being squandered on certain plays. Meta's message of more spending when revenues were struggling looked cloudy to investors. And issues like cybersecurity also coming up. For example, the Federal Cybersecurity Safety Board issued a report after Chinese cyber operators broke into email accounts of senior US officials, saying Microsoft is shoddy with its cybersecurity practices, and concludes that its security culture was inadequate. And then, of course, there are several other antitrust cases coming up with the US DOJ, Department of Justice, coming after a lot of these large tech companies. We could see the Nasdaq, of course, later today boosted by Microsoft and Alphabet earnings as a result of the strong results and guidance. The world's biggest mining firm, BHP, wants to buy its rival, AngloAmerican, Headquartered in London but founded in South Africa since 1917, the deal could go for $39 billion. Anglo is the world's largest producer of platinum, and the thinking is that this comes at a time when Anglo has seen its latest annual profit plunge by 94% in 2023 and shares depressed, if not significantly undervalued, according to shareholders who are opposing the deal as opportunism, calling it an opportunistic deal which doesn't factor the huge potential of its copper assets. BHP's portfolio is not as diversified as AngloAmerican, and BHP definitely has an eye on Anglo's copper mining assets in Chile and Peru. While 50% of platinum demand comes from its use in catalytic converters for cars, trucks, and buses for internal combustion engines, copper is a major component in electric vehicles, used in electric motors, batteries, inverters, wiring, and in charging stations. BHP has already said it will expect Anglo to spin off its diamond and platinum assets ahead of the acquisition. The tie-up also gives BHP 10% of global copper mine supply ahead of what many say is an expected shortage that could send prices soaring. BHP could also overtake other rivals by this deal, trying to position themselves for the global energy transition. Meanwhile, BHP shares fell 4% at close yesterday as investors feared it may be paying too much, eroding profits, especially if it has to sweeten its offer. But why is South Africa's Mineral Resources Minister Gwede Mantashe telling the FT that his country's experience with BHP was not positive, although this is not an official government reaction? Indeed, many African countries feel a frustration that the likes of BHP appear to take advantage rather than collaborate to support the sustainable development of host economies. While hundreds of battery production and EV factories exist across Asia, North America, and Europe, if you look at Africa, there are only a limited battery assembly operations. Say in South Africa, the African Continental Free Trade Area has placed the lithium-ion battery value chain as top priority in a lot of their ventures, and the DRC, Democratic Republic of Congo, and Zambia, being the largest producers of copper, have plans but have made little progress beyond extraction. South Africa and Morocco have announced plans to build lithium-ion batteries, that's factories beyond basic assembly. This has to be the time to accelerate value add in Africa and change the paradigm of focus on raw material extraction only to be a vast market for imported EVs as an energy transition revolution gathers momentum globally. Unfortunately, leaders have chained Africa to a resource-based economy mindset where wealth is determined by how much we can extract and export of our resources, while what is even worse is that with excessive government participation in key resources like oil, the likes of NNPC, for example, should long have been in private hands. We have inefficient economies where productivity is very low, and we are not just sub-optimizing, outputs are being wasted, if not outrightly stolen. But beyond looking for efficiency, we need an accelerated path to a knowledge economy driven by technology, innovation, and the production and dissemination of knowledge rather than natural resources. Africa urgently needs leaders that can leverage its strengths to leapfrog through courageous reimagination to help countries accelerate to emerge as knowledge economies, so we have our own Googles, Meta, and Nvidia. In Europe markets, we can see regained momentum again after the lull in the previous session. As expected, US stocks are climbing as investors digest positive earnings reports from Alphabet and Microsoft and the latest inflation data. That's it from me on Global Business Insights. Please share, kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. Thank you very much for watching and following. Bye-bye.